Hi, everyone. I want to welcome you here today to Investor Training with 1000 Angels. Thank you so much for joining. Today's session should be really interesting. We're going to be learning all about some of the tax benefits and advantages of startup investing and how you can use them to maximize the performance of your portfolio, and maybe learn some things today that you didn't know about some of the tax benefits that the government has established for folks who are part of the innovation economy as investors. So I want to welcome you here today. Just to preface today's webinar, as usual, we want to keep it very interactive. So would love for people to use the chat or Q&A function to ask me any questions that you might have. I'd love to hear your questions, and feel free to kind of interrupt me as we go along so that I can address them. So once again, thanks so much for coming. I am going to share my screen and we will get started. Great. So here we go. Thanks, everybody. I see we have a few people who have just logged on. I'll give everybody a moment to get settled. So in today's masterclass, we're going to be covering some of the amazing tax advantages of early stage investing. And just to introduce myself for those of you who are new, I'm Erica Diagnan-Minahan. A lot of people are completely baffled by how to pronounce both of my last names. So it's Diagnan-Minahan. I know the spelling is quite confusing. And I am co-founder and managing partner at both 1000 Angels and Rain Ventures. I've been actually investing for the last 13 years in seed and Series A. It'll actually be 14 years in the winter since I got my first start. And during that time, I've made investments in hundreds of early stage companies, as well as worked with thousands of founders in various capacity, reviewing their applications, advising them, and helping to find the most attractive investment opportunities for both my limited partners and 1000 Angels members. I actually got my start as executive director of Golden Seeds, spent a few years during that time as managing director of Dream Ventures, and actually founded 1000 Angels about 4 years ago. Just so you know a little bit about my background, I did my MBA in finance at Columbia Business School, and I'm originally a California girl, although we're based in New York City now, graduate of UCLA, so go Bruins. So let's talk a little bit about how and why startup investors can benefit from the tax incentives that are in place so that you can be as informed as possible before you start developing your portfolio or as you continue to develop your portfolio. And really our job is to help our clients understand how they can actually maximize after-tax returns on startup investing. And there are a couple of different tax minimization strategies that folks can use to actually minimize tax and maximize after-tax return. So, when exactly is startup investing tax advantaged? We're going to go over some basic guidelines, really two primary strategies that folks use to minimize capital gains tax that you probably want to be aware of. And we'll work on, how you can make a decision to best take advantage of these tax benefits. So the first one, and I think the most vital one, is QSBS. So if you've heard of QSBS before, we're going to talk a little bit about what is QSBS and why is it so important to early stage investors. So a qualified small business stock is the stock of a qualified small business as defined by the IRS, right? The Internal Revenue Code. So how do they define it? Essentially, it's an active domestic C corporation whose gross assets at the time of investment do not exceed $50 million. So that means that the total assets of the company at the time you're investing in the company do not exceed $50 million. So this is actually a pretty liberal definition. As you know, most of the companies that we are investing in at 1,000 angels, might have a pre-money valuation of $10 million or $15 million. So, even that kind of pre-money valuation does not apply to this $50 million. So a company could technically, you could be investing at around where the valuation is $60 million, and they would still qualify as a QSBS, because the gross assets valued at the original cost are less than $50 million. So this applies for quite a few of the private market rounds for private companies, and has been an amazing, I guess we'll call it a loophole slash, tax advantage for folks willing to take risk, that's really helped people who invest in the private markets avoid a substantial amount of capital gains tax. So in order to actually claim the tax benefits of the stock being qualified on the investor side, the following rules need to apply to you. So first of all, as an investor, you cannot be a corporation. And so most of you are, obviously investing in your own name or in some sort of investment vehicle or LLC that is fully controlled, but it cannot be through a corporation. So something that's important to note. And secondly, the investor must have acquired the stock at its original issue and not in the secondary market. So this is actually really important, because I see a lot of folks who are interested in kind of, getting into private companies and secondary market shares. When you do that, this amazing tax benefit no longer applies to you. So, this is important because what it means is that it's an investor who's directly investing in a startup, is, contributing capital to the innovation economy and, taking some risks there to actually invest in the growth of a business. So it's, key to part of the tax code. The next is that you have to have purchased the stock with cash or property or accepted it as a payment for a service. So most folks who are making investments in, the startups on our platform or other, private investments definitely fall within this category. I'm not 100% sure who would not fall within this category, but I'm sure there are some examples. I'll have to do some research and come up with them, but this is a checkbox that basically 100% of our investors meet. And then next, you have to have held the stock for at least 5 years. So this is kind of an extra long-term capital gain situation. But for investors who are investing in companies kind of at the seed or Series A stage, this is very much par for the course. The time horizon to liquidity is pretty much hopefully expected to be anywhere from 5 to 10 years. So if you're investing in a seed or Series A stage startup, it's very likely that you will meet this condition. And then lastly, at least 80% of the corporation's assets must be used in the operations of one or more of its qualified trades or businesses. So I think this rule here kind of, maybe helps people get around, investing in a corporation, and that corporation, goes and invests in some other financial assets, to sort of game the system. But as long as, it's a business that is created for actually doing a business, you're going to meet this requirement. And I would say that certainly 100% of the companies that we've worked with certainly meet the requirement. And then, lastly, just to really be aware of is that only certain types of companies are actually eligible. So, not every single category of business qualifies for Section 1202. So we'll go over what types of business qualify and what types of businesses do not qualify. So companies that are in hospitality, personal services, financial sector, farming, and mining are not eligible. Certainly I'm sure some of you have come across some investment opportunities in those categories. We technically are not usually within any of those categories, so not something that our members have to worry about. But if you're kind of looking to apply this to external investments, it's a good thing to be aware of. And the companies that are eligible are companies in technology, retail, wholesale, and manufacturing sectors. So, if you're looking at something in any of those sectors, you're absolutely eligible for a QSBS investment. So the tax exemption is really fantastic because it basically allows you to avoid 100% in almost every scenario, 100% of the federal capital gains taxes incurred when you sell the stake in the startup. So that's pretty material. I think that back, years ago, kind of 1993, it might have been something like 50%, but they increased this exclusion, so it's all the way up to basically 100% with a slight limitation. So the one limitation is that the exclusion is available on gains of up to $10 million or 10 times the basis of your initial investment, but whichever is greater. So unless you're investing, more than $1 million in any particular startup, which most of you are not doing, you're probably going to be good and, within the 100% exclusion. If your gains end up being more than 10 million, well, I'm sure you're going to be happy to pay the capital gains on whatever is beyond that. But this covers, a very large window for appreciation for most of our investors. So up to 10 million or 10 times the basis of your initial investment, whichever is greater. So very generous. So we'll give you an example. If you had invested $50,000 in a QSBS back in 2014, you could sell that stock later for up to 10 million and pay 0 federal income tax on that gain, which would represent a savings of approximately $2 million at today's capital gains tax rate. So it really is material, and it's just kind of a nice little kicker on, what are already potentially very attractive returns for this asset class. So it's something that's great to be aware of. A question that some folks might have is, well, what if the company has an early exit, right? What happens if, I actually get my liquidity in less than 5 years? So number one, that's not the end of the world, right? A gain is still a gain. And, if you have to pay some capital gains tax on it, no big deal. But there is also another loophole on top of the loophole, which is that if your exit happens before the 5-year window, you can actually still qualify to roll over the original investment plus gains into another QSBS, and yet still have an opportunity to continue to be eligible for tax exempt status. I'm sure that some of you guys have heard about folks doing this in real estate. It's also eligible for QSBS investors. So from a tax perspective, there are a lot of advantages written into the tax code that are there to help mitigate the risk that early stage investors are taking on, to make this asset class a little bit more attractive to folks who might be nervous about dipping a toe in the water, and basically to help kind of juice those eventual returns for folks who are playing a critical part in supporting young companies within the US economy. So I just want to stop and check to make sure there aren't any questions. Looks like Q&A is open, and I'm not sure that I can see the chat. Okay, great. So we don't have any questions so far. So all of this is like pretty simple stuff. Today's session is not going to have to, dig too much into complex math, but just to kind of make you aware of some of the, risks and benefits as you're building your portfolio, and a couple of the different ways to actually execute your strategy. So being aware of the QSBS exemption is key for investors. Wait, I think I have a couple questions. Let me just address those before we move on. Great. Renee says, will you share the deck? Yes, Renee, I will. And for those of you who've been asking for previous decks, I will be sharing them. I actually need to kind of set them up in some sort of a DocSend or a platform like that to make it easier for me to share them, rather than sort of emailing around the actual deck. So you will have access to it. I'll make sure to get that done before the end of the week. So one of the reasons, and there's always sort of fun stuff happening in the news that gets people excited about various topics in startup investing. But one of the reasons that this has, become an area of curiosity is definitely because of, what we call the Romney IRA. So, I think it was probably over the summer. Actually, no, it was actually a while ago. I can see from the dates on these articles, but I guess basically, sorry, not over the summer, back in 2012, folks started becoming aware that, wow, like how did Mitt Romney get, $100 million in his IRA? Like how on earth did this grow so big? And, is there some way for me to sort of replicate this strategy? So let's talk a little bit about possible investment strategies for alternative assets like startup equity using retirement accounts. So one of the great ways to execute an early stage investment strategy can be a retirement account. Now, there are positives and negatives, and it really depends on your own situation. So, in sort of the first case scenario, we had this example of the fact that, you will be able to take your gains as long as the instrument is held for 5 years, capital gains tax-free. So, that's kind of one strategy. The next strategy is using pre-tax retirement accounts to execute your investment portfolio. And the reason that this can be attractive is because of something that we call the liquidity premium, right? So how can we actually take money that we have and use it in the best way possible? How do we use the liquidity premium to our advantage? And what is the liquidity premium? So, you definitely, if you're on this call, you understand that there is incredibly high return potential on investment opportunities at the early stage of a company. But, the downside is that even when you're investing very carefully in companies that perform well, you still have to deal with total lack of liquidity, right? So, not only do you not know when you're going to get a return out of the company and for exactly how much, but, it's sort of going to come when it comes, and it's very hard to get liquidity prior to some sort of an M&A event or IPO or, other situation. If it's really very much at the company's discretion how and when they want to make liquidity available to their investors, particularly for early stage investors. And it's why you basically pay a liquidity premium for assets that can easily be turned into cash, right? So if you think about your marketable securities within any other account, you do essentially pay a bit of a premium because you're able to reasonably convert them into cash almost whenever you want. And the reason that that liquidity premium is there is because, it costs a lot of money for somebody else, some external firm to make a market for your financial assets. And because the market cap for, these early stage companies is not so large and it's, not public, it's not regulated in the same way, it's largely not available for early stage private equity investments. There have been some companies that try and do sort of secondary market private equity transactions, but similarly, it's also very expensive and it's just not available for everything. And there's no way to know whether or not somebody, will attempt to do this for your particular securities in the future. So that liquidity premium is real. And it's basically why private equity and venture capital firms are able to generate returns of 20% or more annually, where in the public markets, you can get around 7%, right? If it's, sort of a good couple of years. And that liquidity premium, that willingness to sort of give up access to your cash can help you generate outsized returns for your own portfolio. So, here's the question, right? What if you already have money that you can't even touch for the next 10 to 20 years, right? Without paying a penalty. Things that, have assets that basically have kind of a built-in liquidity premium. Would it make sense for you to pay that huge liquidity premium to keep it in assets that can be converted into cash at a moment's notice? Well, in certain cases, yes, but probably not in all cases, right? So if you have assets that are in highly liquid securities within a retirement account that already has a built-in liquidity premium through withdrawal penalties, but you're investing it in things, that you can liquidate right away, essentially you would only be keeping it for the option that, in some sort of emergency scenario, you could sell it all, liquidate your retirement accounts, and then pull that money out for a disaster. But, assuming that you're planning on, keeping the assets within the account for a sustained period of time, you are paying a liquidity premium that you probably will not be able to take advantage to. So there is an advantage possibly to putting those assets that can earn that steep liquidity premium into assets that actually provide that extra return, right? So where you're actually being compensated for the fact that, the money is not nearly accessible. And this is really how big firms, are able to generate massive wealth and outsized returns. So sort of a rhetorical question, but, of course, I do want to point out to everybody that, clearly there is the downside scenario that you need to, very quickly liquidate your retirement account for some immediate financial crisis. So, you probably already have that money, right, that you can't access for decades without huge penalties. And it's probably for, 99.9% of people except Mitt Romney, and, his buddies being invested in very liquid market securities that have reasonably low expected returns. So if you have an IRA or a 401k account, you're already sitting on money that is long duration and has got a built-in liquidity premium. So for those reasons, using a self-directed IRA or 401k for startup investing can actually be beneficial. So we'll dig in a little deeper as to exactly why. So why are some of the reasons that you might want to use pre-tax dollars to invest in illiquid long duration assets? So the first is duration matching, right? So these assets in your retirement account are long-term assets that are locked up for many years. The assets that you purchase when you make an early stage startup investment are also potentially locked up for many years. So it gives you the benefit of duration matching. Secondly, it gives you the benefit of liquidity matching, right? So illiquid assets in an account that already is earning that illiquidity premium, right? So we're better matching the fact that this is money that we were already planning not to access. So why not also earn the liquidity premium that these sort of assets do with money that you're planning not to touch anyway? So, the point is that a well-diversified portfolio of early stage equity can be developed in a very tax efficient manner within a retirement account. Okay. And a lot of people will use, IRA or 401k assets they've built up over time, roll them over into a self-directed 401k or IRA, and then use that money to build their portfolio of direct early stage investments to their benefit, as you've seen some folks do. So we use what we call a self-directed IRA or 401k to execute this strategy. There are several firms out there that do this. One that I just know offhand, Alto IRA, does it pretty inexpensively. And over the last few years, folks have been able to develop technology to make it even easier, even cheaper to use retirement asset funds for all sorts of alternative investing. So, there are obviously a lot of limits around the types of investments that you can make with a self-directed 401k or IRA. Clearly the types of investments that you'll see on 1,000 Angels are really eligible and perfect for this type of vehicle. And of course, the main caveat for people who are thinking about, oh, how could I use this for other investments is, there are a bunch of rules, but particularly that there can't be any sort of self-dealing. So, if it's a company that you don't have an arm's length relationship with, an asset that you might be engaged with for personal use in any way. There are a lot of other restrictions, but I'm going to sort of limit our conversation to using these vehicles for the types of investments that we offer on 1,000 Angels. But as far as, actually building up these vehicles, you can absolutely roll over any existing assets that you have in existing retirement accounts into self-directed accounts. And then going forward, there are obviously the same contribution limits as regular IRA and 401k plans. So for IRA, I think the max contribution is $6,000. And for 401k plans, it's close to $20,000. So, if you're trying to sort of build a portfolio from scratch with these, you might not be able to sort of quite get there on the contribution limits to add too much to your portfolio. But if you are, say, rolling over $100,000 of existing retirement account assets to fund an account to start making your startup investments out of, you can actually probably sustain that quite nicely and be able to make, 1, 2, 3 investments per year with existing capital. So it's a great way to think about how to use liquidity matching and duration matching to optimize your investment portfolio. The other thing too is that, obviously assets from your existing retirement account can be rolled over into this account. We sort of covered that. And then, the one little sort of caveat on this part of the strategy is that the withdrawal rules are the same. Right. So, you will trigger a 10% early withdrawal penalty if you want to withdraw the assets prior to, age 59 and a half. And obviously you have to start making distributions mandatorily by age 70 and a half. But I think most critically is to realize that the distributions that come out of a traditional self-directed 401k or IRA would actually be taxable at ordinary income tax rates and not subject to this very valuable QSBS tax exemption. So unfortunately, they did plug that loophole that you can't sort of get the tax exemption on the way in, on the way out. But depending on your particular situation, you may want to just use traditional sort of after-tax assets in order to make the investment and, look for that QSBS tax exemption at liquidity, or you may prefer to use your existing retirement account assets and try to maximize the value there, yet knowing that when you do take the distributions, they'll be subject to ordinary income tax rates. So those are two of the really beneficial ways that you can use some of the tax benefits of startup investing to maximize the value of your portfolio and to make getting started as an angel investor as accessible as possible. I hope that you've learned a lot today. It's a very interesting and very potentially valuable topic. If anyone has any more questions, I would love to open it up for Q&A right now. And if you're interested in learning more and getting started early stage investing, I'd love for you to visit 1000angels.com, as well as you can send me an email, erica@1000angels.com. I'm happy to set up a one-on-one discussion with you to find out if this is a great strategy for your portfolio. So thank you guys so much for joining. I hope everyone has a great day.